So thanks, Helena, for inviting me. Like Helena said, I'm one of the founders of Mode. So Mode is a platform for analysts and data scientists. We build a tool for basically these folks to be able to produce the work they need to produce, build things like reports and dashboards and data tools, and distribute them out to folks around the organization. So our customers are primarily data scientists who are trying to share their work with their coworkers. But I'm not going to talk about that, obviously. So I'm going to talk about a little bit of that, actually, of using analytics for fundraising. And so this is something that we care about at Mode for a couple reasons. This is Mode. One reason is, obviously, we ourselves are a startup. This is a picture of, I think, the day that we actually started the company. These are my two co-founders. And so we've gone through this fundraising process ourselves through the course of Mode's history, which is now 5.5 years. We have raised like 6 different rounds of money. This is a process we've done a lot. Through all of this, obviously, there has been some success and a lot of failures of trying to raise money. And so we've learned a lot about like how this process can work. Another reason, though, is that what Mode does is it's this platform for data people. It's a platform for data scientists and analysts. And a lot of the work that they do is actually building out the fundraising decks that they want to be able to raise money off of in Mode. So this is a screenshot of Mode itself. This is kind of what you might look at if you were trying to put together some numbers for fundraising. I'll talk about what that is in a bit. But because of that, we end up talking to a lot of our customers about what they're trying to do on the platform. And this is one of the things that they do a lot of. And so we have a lot of conversations with people, not just about like how we've raised money, but about how they've done it as well. And so we've seen kind of what works, what doesn't, particularly from the analytics side. And so that's kind of what I want to talk about here. So real quickly, before getting into it, like who is this for? What is this about? There's a few different things I want to outline because fundraising can mean a lot of different things and can mean sort of a lot of different parts of that process. First of all, the main thing I'm going to talk about is like what to pitch, not when or who to pitch. If you're making decisions about when do you go out in fundraising, that's somewhat of a different question. If you're making a decision about who you should actually go ask for money from, that's also a different question. I'm not going to talk about sort of like which investors you should be asking for, but more about once you've decided that, how do you actually pitch them? I went faster than I wanted to. The second is this is primarily for early stage companies, not growth stage companies. If you're in the like Series C and beyond, the fundraising process is very different. In those cases, you're often just sending big decks of numbers. They're called data rooms. People plug them into the models that they're going to run, and then they decide whether or not to invest. It's more of sort of like a PE way of investing where it's all very quantitative. They don't care as much about who you are, care as much about your story. They care much more about just like give us the numbers and we'll see if it fits the model that we want to invest in. And so this is much more the kind of seed A, B round kind of fundraising and the way investors think about that. Third, this is about VC fundraising, not debt or friends or family rounds. There's a bunch of different ways you can raise money. The VCs, particularly the early stage VCs, think about this in kind of a consistent way. This is primarily designed for how you think about fundraising for that. If you're doing debt rounds, it's somewhat different. If you're doing friends and family rounds in very early stage, it's also somewhat different. That's a process that very much depends on the people you're actually going out and talking to. With VCs, there's a lot more sort of institutional knowledge about how they go about fundraising. And so the things they're looking for there is fairly consistent. Finally, this is for the rest of us. This is not for like the sort of companies that are blowing up like Slack and Bird. If you are Slack and you have a chart that looks like this, or you are Bird and you have a chart that looks like this is your fundraising deck. Like this is not for those use cases. If you're one of those people, great, congratulations, you can leave. Like this is all you need to show and people will write you a bunch of money. But if you're not that, then you have to tell a different story. And so that's really what this is about, is how do you put that pitch together? Like what's in the pitch kind of for the rest of us? And so depending on who you ask, like if you go around and Google this, you'll come across a bunch of blogs written by VCs, and you'll find a bunch of different things. At its core, though, most pitches have like these kind of 6 things in them. There's some story about the team, there's some story about the vision behind what the company is, some story about what the market is that you're going after, and then there are these sort of growth and traction, product stickiness, and acquisition economics. And you can kind of talk about these things in slightly different terms, but every deck needs to tell this story. I'll talk about these 3 things in a bit later. These are kind of the softer side of the pitch. This is sort of how do you present yourself as being an expert in this market. How do you present yourself as being the person to solve this problem and like connect these three things together as being one unified story? The meat of what I talk about, though, are these bottom three things. And so these are the places where data really matters. These are the places where you're trying to tell a story about how have you demonstrated that you have these three things or on a path to these three things. And these are the places where VCs are going to look for data to prove it. You can't sort of put together your resume and say, hey, here's why this is going to work out. They're looking for sort of hard numbers on your success. So these are the three things I want to mainly focus on, is how do you tell a story, and what is it that VCs are looking for when you're telling a story about these kind of three parts of your pitch. So for the rest of the talk, that's what I'm going to talk about, is the data that investors want to see. How do you actually get that data? So it's great to say here's a chart, make this chart. How do you go about actually putting that together? And then a few closing tips on pitching that we've learned along the way of things that we've done well or things that we've done really badly that we would want to do differently if we did this again. So first, start off with the growth and traction part of this. So how do you actually talk about that? First of all, like, what is it? So growth and traction is people, like VCs, asking the question of, are people actually finding your product? Is it something that people are willing to pay for? Basically, like, is there any market for this? Is this something that we think can grow? That's really what they're asking for when they're asking this question. And so there's kind of three main ways that investors will look at this. They want to look at signups. Depending on what your product is, a signup can mean a slightly different thing, like a sign up or a purchase or whatever. They want to look at daily active users, or how many people are coming back to your product every day. And they want to look at monthly revenue. And so all three these things are the types of things that point to like signs of, hey, there is some growth for this company. So I want to run through each of these. I'll kind of do this a few times, but run through each of these like a little bit more detail about what these metrics mean. So signups, this is like pretty simple. How many people are signing up? Say that you're an app. How many people come and sign up for your app every day? Again, say that you're like a content company. How many new people come to your content site every day? Basically, how many new people are coming to your platform every day? Again, this is fairly straightforward. One kind of tip that I would add if you're thinking about this is, and this is true for most things, but it's a good point to point it out, is use monthly numbers when you're pitching. Never use cumulative numbers. One of the things that's sort of the surest sign that a VC will start to write you off as like, this isn't a real pitch, this is a pitch where you're trying to pull something over my eyes, is you have cumulative totals. So if you have a chart like this that's like always up and to the right and looks amazing, it's going to look good, but that is like, VCs aren't that sophisticated when it comes to data. They're sophisticated enough to know that this isn't right. So don't do this. Do something that looks more like this, that's like monthly numbers. It should go down occasionally. That's fine. If it's like this cumulative thing, it's going to get called out as being pretty bad. The second thing people look for is something like daily active users. So how many people are using your product every day? Again, if it's a content site, how many people are coming to that content site? If you're selling like a piece of hardware, how many people are using that hardware? Again, that's pretty straightforward. I think that one of the key things here, though, is being very precise about what active means. When you're actually pitching investors, they will ask this question. If you say, hey, we have 100,000 daily active users, what does active actually mean? If you have an app, does it count if they get a notification but they don't open it? Does it count if they get a notification and they just miss it? If you're Uber, is a daily active user somebody who opens the app? Is a daily active user someone who gets a notification? Is a daily active user someone who takes a ride? It doesn't matter that much which one of those you choose, but it does matter that you know. Another place where pitches can go really wrong really fast is someone asks, what's a daily active user? And you don't have like a clean answer for that. You're like, oh, it's this, or I'm not exactly sure what happens if someone gets a push notification and how would I deal with it. So if you get something like this, like CNN sends this fidget spinners notification, like, am I an active user now that I saw this? And that there's a sort of broader point of that, which is when you're having these conversations with investors, know what your data actually represents. Again, know what a sign up is, know what a daily active user is. You will get questions on people sort of asking, hey, what does this mean? And again, the specifics don't matter as much as you having a good, like, well-defined reason as to why you have chosen that metric in that way, and you understand what it is. You can get yourself in a position where you like look very bad if you could ask one of these questions and you sort of stumble on, I don't actually know what this number is that I'm presenting you. Finally, a good way to look at actual traction is just revenue. So a lot of companies are sort of pre-revenue. That's fine if you don't have revenue. Like, there's not always an expectation for you to have it, but if you do, they're going to ask questions about it. They're going to want to see how much is it growing by. As a kind of rule of thumb, well, it's a couple things actually. First, keep track of this early. So this is something that I've seen a lot of startups do poorly. We were included in that. Is especially when you're early, you'll start collecting revenues from some sort of weird places. You'll sign up first couple customers. You don't really have a sort of revenue system in place. You'll just get someone to write you a check. Someone will put you a credit card in a Square account that you just created. It'll be easy to start to just collect that revenue in sort of one-off ways. Very quickly what will happen is you'll realize you don't know how to track it. And this only gets harder. It only gets worse if you're tracking revenue initially in an Excel file, and then you start tracking it in Salesforce, and then you start tracking it in Recurly, and then you say, how do we combine all these things together? Like, think about from the first dollar you collect, how are you going to keep track of the money that's coming in? And at least just keep like a master spreadsheet of every month, this is how much money we made, and have this like audited list of, we know this is right. I can't tell you how many times we've had to go back and sort of re-audit all of our bookings because we didn't do a good job of keeping track and keeping it clean early. Like I said, it's easy when you're small because you're not making that much money. The bigger you get, the more that complicated that gets, and it only gets worse until you make it clean. Second, there is this concept of like a T2, D3 rule. This is another thing that investors are often looking for with revenue growth. It's not something you have to have, but it's a good like rule of thumb of how fast you should be growing for investors to be excited about you. So what that means is basically like a revenue track like this. So in year one, you should be making really these people tend to think about in like millions. Like that's kind of where they expect this growth rate to happen. If you're making like $1,000 to $3,000 in a year, that's not very good. But basically they want a growth rate of you tripling for 2 years and then doubling for 3 consecutive years. And that's again, this is like a very good trajectory, but it's the kind of trajectory that sort of traditional VCs are looking for. They want to be able to see a path to that. And so again, if your revenue is growing 50% year over year, especially if you're kind of below the $1 million a year mark, that's a place where investors aren't going to be as excited. Like that's just not the growth rate that most investors are looking for. It doesn't mean there aren't financing options, but it means that the sort of like high profile investors are often going to be less interested.
Questions okay?
Sure.
What's the equivalent of consumer startups that may be ramping up on user base but not revenue?
There's not as much one. A lot of it is like the viability of your ability. Like, can you get here? Can you eventually turn it into this kind of money? Different investors will have slightly different takes on that. Mode is not a consumer product, so we don't have a ton of experience there. But the sense that we get is different investors will have different appetites for how long will I be willing to fund a consumer startup that doesn't make money? And like some investors will fund it indefinitely and be like, this thing one day we could turn into a ton of money. Some people will be like, we want to see it earlier. That's often more of a particular investor's appetite for it.
I've heard 1000x in user growth in year one. Is that
I mean, year one is like growing from nowhere. Like 1,000x is crazy if you have 100,000 users. I mean, 1,000x and 100,000 users is like you suddenly are Facebook in 2 years. But yeah, if you have 10, 1,000x is like 10 to 10,000 is probably, yeah, you would expect something probably more than that. So again, this is kind of the trajectory that folks look for revenue. So the second part of this, product stickiness. So once you have that, once you're able to demonstrate some signs of traction, like, hey, are people signing up for your product? The next step is product stickiness. It's basically how much are people sticking around? And so this is a question of, do people actually use your product? Great, you've been able to market it to people, you've been able to get it out to the world, people are signing up. Do they want to keep using it? Like, have you built a product that's actually valuable to them? And that's kind of what the real question here is this something that is, if it's like you've marketed it well, great, but have you actually built something that's meaningful, something that's valuable, something that people want to continue to use? So again, kind of 3 main ways that folks look at this. The first one is retention, the second one is this DAU over MAU concept, and the third one is this slightly more complicated thing called a quick ratio. So retention. So retention is pretty basic. It's just how many people come back to your product after they use it for the first time. The one place where this can get a little bit more complicated is it's not just like users coming back. There's also questions about customer retention or revenue retention. Depending on your business, people will ask different questions about these types of retention. So I can quickly kind of outline what each one of these is. So user retention is pretty basic. This is, say that you have like 6 people sign up for your product on one day, and a month later 3 of them come back. then you have like 50% user retention. So that makes sense, right? So how many people sign up, like how many are coming back each given month, and there are kind of these retention curves that you end up having with, say in month 1, 3 come back, in month 2, 2 come back, in month 3, 1 comes back, and that person keeps coming back. Then you have kind of a retention curve that maps out there. The second thing is you'll hear customer or logo retention. If you're like a B2B company, this one is particularly important because your customers are often less like the individual users of the product and much more the actual people who are paying for it, like the companies themselves. Sometimes people call this logo retention. It's the same thing as customer retention. What this is say that you have like three businesses paying for your product, and on the next month that 2 come back, then you have 67% retention. Again, relatively straightforward. One place where this can actually get a little bit more complicated is if you're signing annual contracts. Say that like all 3 of these people signed annual contracts on month 1, they have to come back on month 2 because they've paid for it. And so there's like some questions there of how you actually calculate retention, and different investors will think about that slightly differently. Like, is it 100% retention, or is it sort of not, like there is no retention number because they have to be there? And so that's just like one of the things to kind of think about. But in general, it's like how many of your customers continue to return. The final one of these is revenue retention. This one's a little bit more complicated, but it's not bad. So suppose that you've got these 3 customers and they're paying you $40, $30, and $30. And then the next month, one of them goes away, but this one comes back and pays you 60, and this one comes back and pays you 50. Like in reality, this is, you've lost a customer, but you've actually made more money. And so you have like a positive retention, or it's positive churn, a negative retention rate. For most B2B companies, this is actually what investors expect to see. They would expect to see greater than 100% revenue retention because they'd expect like your existing customers that stick around to continue to grow. A lot of companies will try to follow this pattern where they'll sign a bunch of companies for smaller dollar amounts. Some of them will leave because the product doesn't end up sticking, but the ones that do stick around end up growing bigger and bigger to the point where you actually make more money off of that cohort than even the ones you lost. Yes?
So on the B2B model, you said earlier about the contracts, right? It's a great example. Are the VCs more sophisticated enough to realize that that turnaround time is different, like from monthly to regular user based on an app versus annual contracts?
Yeah, yeah. That people will, there are very big distinctions between the way people will evaluate like B2B and B2C products. Within B2B, there's also differences. There's also like a lot of B2B products now that are kind of B2B, but like they sort of sell like a B2C. Like Dropbox obviously kind of has both sides, but Dropbox is one that sells kind of like a B2C product even in their B2B market. And that's the place where the level of sophistication isn't always there. And you often have to kind of explain this is how our model works. That there are some kind of, the stuff I'll talk about actually a little bit after this, some sort of basic metrics that people look at and basic benchmarks they'll follow. But if you have a model that doesn't quite fit, you often have to help people sort of pull out of the model that they might expect. So this is retention. In general, like which one do you use? It's important to use the one that makes the most sense for your business. It's often easy, especially in like a B2B context, to think about which one of these is the best. Like you may have really good user retention because everybody who uses the product like is paid to come. They have to come back because their boss told them they have to. Or as a consumer product, you may have like really good user retention but really bad revenue retention. Like show the one that actually is meaningful for your business. You will get asked sort of how do these other numbers play out, and it's important to show the one that's the one that actually tells the story behind how your business is going to grow. Okay, so the next thing here is this DAU over MAU number. This tends to be more consumery, but if you have a product that is used by end users, if you have sort of a Dropbox type of product where it's a B2B product, but it's used by like end users, you can also look at this for that. What this number is it's basically the average number of daily users divided by the average number of monthly users. It's a little bit of a weird like metric, and I think there's actually an easier way to explain it, which I will attempt to do. So here's how this works. So these DAU over MAU numbers mean, say that you have, on average in May, 100 people use your product, and then a total of 1,000 people use your product over the course of the month. Then you'd have a DAU over MAU ratio of 10%. Similarly, say that you had like 500 people use it on average on any given day in May, and then 1,000 people total use it in the month. You'd have a DAU over MAU ratio of 50%. These are like sort of weird numbers. They don't like really represent anything. It's kind of hard to think about what does this mean. There's a better way to think about this, in my mind anyway, which is if you multiply this by 30, you'll get the average number of days that somebody used your product. So what that really means is you can think about like this is how frequently people come back to your product. So if you have a DAU over MAU ratio of 10%, it means on average a user who uses your product in a month uses it 3 days a month. And if you have a 50%, it means they're using it 15 days a month. So if you think about it that way, the way that you tell a story with this number really depends on how your product needs to be used. If you're Facebook, and Facebook is the folks who popularized this, if you're Facebook, you want to see a really high number of this because the way they sold was people use this thing all the time. Like they're addicted to it. They have to come back to it every day. If you're TurboTax, like this isn't going to happen. Like people don't want to use TurboTax every day. You can be a very successful product selling TurboTax if they use it once a year, much less 15 times a month. So use this number if you're something where you want to prove that like you're a daily use product. If you're not a daily use product, this number doesn't really mean that much for you. For some benchmarks, I think that Facebook's number was around 40 to 50%. And so like very, very like popular consumer apps tend to cap out here. This is kind of a useful number for B2B apps like Slack, for instance, uses this a good bit because it shows how much people use Slack every day. But if you're a B2B product that's not sort of an everyday use, then it wouldn't be as useful. Yeah.
So can your ratio be above 1.0? For example, Snapchat has a ratio around 2.
No, so that's you can't. Like the math of this does not allow that.
You'd have to count how many times they entered your app or software during a given day.
So the way this is like the average, the reason this math works out, is the average number of people who use your product during the average day divided by the total distinct monthly users. So it's impossible for any day, any average to be higher than the total distinct one because that's like all the people that use it in a month. But if you think the reason this works is if you think about if those two numbers are exactly the same, it means on average if 1,000 people use your product every day and 1,000 people in total used it in the month, all the active people used it every day, which is how this number works out.
That's how you count the daily user. If every time they enter your app, you count them as one.
Yeah, so that is then a different number.
Right.
If you counted like sessions divided by MAUs, then you would get something different, and that is a place actually. There's a kind of a good point in that investors don't know what that number means, and that's a place where like the consistency here matters. If you present sessions over monthly active users and you say, look, it's 6, or like this is 6 and this is whatever, then investors don't. That feels like a place where you're saying, well, I'm taking a traditional metric and contorting it to be something that probably looks really good for me. It's like there is a reason why investors look at a lot of the same stuff, is it lets them be able to compare across businesses. And if you're sort of trying to find the metric that looks good for you, that's a sign of like, well, why aren't you showing me the one that I would have expected to see? Why don't you show me that one instead? And if that ends up being great, but it's best often to not like try to contort these things too much because it often looks like you're trying to not show the other one for a reason. So again, this is often meant for products that are used frequently. If you're TurboTax, you probably don't need to show this. The last thing on here is something called the quick ratio. There's a formula for this. It's not like complicated, but it's more complicated than it's worth showing on a slide. The way I explain this though is, imagine that you're this business. And so these green bars are the amount of new revenue you're getting every month. So those are new customers that are signing up, or old customers that are continuing to pay more. And then these red bars are the amount of revenue that you're losing every month. So they're churning customers or customers who are reducing their usage and paying you less. So your net revenue growth is this orange line. You could also have this exact same revenue growth following a pattern like this. So these orange lines are exactly the same, but in this case, you're adding a lot more revenue every month, but you're also losing a lot more. The quick ratio is a thing to try to measure the differences between these two companies. That revenue growth here will look the same. The daily active user stuff could all look the same. But this one is one that is like growing quickly, but it's a bad leaky bucket. And so this one will have a much worse quick ratio than that one. And so investors are looking for that. This is like often a warning sign for folks. It doesn't like you have to be growing really, really fast for people to have an appetite for something like this. There's always a big concern for investors about these sorts of leaky buckets. And so the quick ratio is a good thing, not only to present to investors to show, hey, this is the world we live in, not this one, but it's also something that's good for you to like kind of monitor as you're growing your business to understand if you're actually facing a situation like this. So like in general, no matter how fast you're growing, this is always going to be a worry, especially for early stage companies. Kind of nothing is a bigger warning sign for companies that don't have a big customer base, rather than them churning through customers really quickly. In general, so the quick ratio, it comes out to sort of a meaningless number other than how do people think about it. I want to say that 4 is the place that's like the number that is good. But again, there's no real way to think about like what does 4 mean. It's just kind of an arbitrary measure that was decided to be good by investors, and that's the world we live in. Okay, so the last step of this is the acquisition economics. So great. So say you're growing quickly, you're keeping customers around. The kind of final big question that people often ask is this sustainable? And this is like, can we scale it? The question this really is asking is like, can we grow efficiently? To some extent, can we become profitable to like the extent that VCs care about that ever? But really, it's like if we poured a bunch of money into this thing, would we spend $100 million and get $50 million out the other end? Would we spend $10 million and get $50 million out the other end? Obviously, they much prefer the latter. And these economics of how you're actually acquiring customers are the thing that define that. So what are things that look at for that? These are kind of the 3 most VC metrics on here. So there's payback periods, there's this LTV over CAC concept, and there's something called the magic number. So the payback period is how long it takes for a customer to pay you back when you acquire them. So say that you go out and you purchase a customer from an ad or something like that. They will slowly pay you back the cost of that ad. It's how long does it take for them to do that. To show this in kind of a simple example, imagine that you spent $500 on Facebook ads. As a result of that, 5 people signed up, so you can pretty easily track through Facebook, like, okay, we spent $500, we got 100 people clicked on our ad, and then 5 people came through and actually signed up and became customers. And let's say that then that means obviously it was $100 per customer for acquiring it. So your cost of acquiring a customer is $100. And say you're selling a product that they pay you $10 a month. What that means is it takes them 10 months to pay you back. That assuming they all stick around as customers, in 10 months you'll have recouped the cost of your original ad spend. And so that's like what investors want to see. That's actually pretty good. Generally, the kind of rule of thumb here is you want a payback period under a year. The main reason for that is it shows that you can grow this sustainably. Oftentimes too, 12-month payback period for like a B2B business means an upfront contract that is bigger than the cost of acquiring that customer. So if you're selling annual deals, in this case, say instead of paying $10 a month, somebody might pay $120 to sign an annual deal. It means as soon as that person becomes a customer, you recoup the cost of your ads. Which means, hey, like if we spend a bunch more money on ads, we're going to start adding money into our bank account rather than taking it away. If this takes too long, you may say like, well, why is that bad? What if this takes 36 months? That still means ultimately we're in the black. Like that's a good thing. The problem is that as a startup, you're kind of a race against the clock. You can't have 36 months of sort of waiting to get your money back. Like you need to be able to grow faster than that. And you're going to run through your money faster than you're actually going to get the money back if this takes too long. And so that's why this is an important thing to look into. Yes?
So how much tracking are they looking for in terms of like if I'm doing gross money on advertising, I get gross revenue from customers?
Yeah.
This ad correlated with this.
So that's a good question. So it depends on the stage. Early stage, not a lot. Like the way that people tend to think of this is it's basically how much money did we spend on ads, how much money did we get in revenue on net, just sort of look at those two things together. They don't necessarily need like track this ad to this customer to this thing, like that gets pretty messy. You can also go into like a variety of complications of how you actually calculate the cost of acquiring a customer. Typically sales will be folded into that, like your cost of sales should be included. The amount you pay out to your sales rep should be included. Some people will try to like make adjustments for different sorts of commissions and make adjustments for like your COGS, basically your cost of goods served. Do they include it in CAC? Sometimes yes, sometimes no. Early stage, that doesn't matter that much. They're basically looking for like, is this ballpark look healthy? Is it, I'm spending $500 on an ad and they're paying me $5 a month and it takes 10 years for them to pay me back. versus it'll take 6 months, give or take. The next one of these is this LTV over CAC. So this is kind of similar, but again tells sort of the long-term value of a customer. So LTV stands for lifetime value. It basically means over the course of a customer's lifetime, how much do they pay you before they eventually leave? Like all of your customers will eventually stop paying you. What is the average value of a new customer over the course of their lifetime? And so this is the comparison of over the lifetime of a customer, how does that relate to the cost of acquiring them? So to go back to this Facebook example, or this example with Facebook ads rather, the cost of acquiring this customer is $100. And again, say you're getting $10 a month from these customers. Say on average they pay you for 2 years. So this first person might disappear like after a couple months. Some of these other people might stick around for way longer. On average, you expect a new customer to pay you for 2 years. That means that you're actually going to get $240 total from these customers, which means that this LTV over CAC is this 240 over 100. And so that's like 2.4. That again kind of seems good. It's like, great, we're spending $100, we're getting 240 back. Seems very promising, seems like a positive return. Actually, that's not going to be great for investors. Like typically the number they want to see is 3. Again, there's some like fuzziness to how you calculate this. LTV is particularly hard to calculate if you're early stage, because like say you've been around for 6 months, how long are customers going to stick around? You have to kind of guess. But this is considered what is healthy. There's a lot of reasons for that. Like one, it means you can kind of scale it quickly. It also is because there's so much kind of flexibility in this number. If you have a really tight ratio here of like 1.5, people are often scared that number's actually not 1.5. It's going to be like 0.8, and then that means every dollar we spend, we get 80 cents back, and that's not a particularly scalable business. Plus, there are other costs to acquiring customers like development that kind of need to be covered by this ratio. So this is kind of how people expect that to look. Finally, there's this concept of a magic number. This is another place where the formula is sort of overly complicated, but it's not that it's like a simple thing, but not complicated for a slide. It's basically comparing revenue growth to total sales and marketing spend. So this is looking at essentially how much is our revenue growing quarter over quarter, and how does that compare to the amount of money we spend on sales and marketing in that quarter. It's similar to LTV over CAC in that it is trying to say, can you put more money into this company, and will we get enough revenue out of it to make that money worthwhile? This one is, again, these numbers are sort of totally meaningless outside of these contexts, but generally the magic number comes out to around 1. 1.5 is considered really positive, below 0.75 is considered not so good, and the middle is kind of, you can make it work, you could not. But these are the places that people are looking for. But the important thing is, it's really trying to be a check on, are we spending revenue, sales and marketing dollars efficiently and actually getting some return from that. So kind of meta tip about all of these things is these metrics are much less meaningful with when you only have new customers. That say you've been around for 6 months and you've just started signing customers. Again, it's really hard to calculate LTV because all your customers may still be there. You clearly don't have like an infinite lifetime value of customers. The amount you're spending on sales and marketing is probably pretty minimal. It's difficult to know what that looks like once you start to scale it. And so if you're raising a seed round, you actually won't get asked these questions nearly as much. But it's important to keep them in mind because you will get asked them later. Like you will need to prove at some point that your unit economics make sense. You will need to prove that, like, if you're trying to grow this into a big business, that there is a market for you to scale it into. And so while you often don't need to like present them in very early stage decks, it's good to keep them in mind because they might show up later, and it's good to kind of make sure that you're monitoring them yourselves to make sure that it's something that doesn't look so bad. That kind of leads to the next question. We have all these things, how do we actually get them? There's like these 9 numbers. Sounds straightforward. Like, what do we do? Like, what do you do now? Say you're in this stage and you're just like, great, how do I put this together? So this is the part where like there is some sort of like data work to be done. But the fortunate thing is it's actually not that bad. So if you look at these 9 things, you actually only need like 3 tables and 7 columns of data to be able to calculate all of this. The first thing is you need a list of every day that your user used a product. So say that you have like a table that looks like this, that's like a date and whether or not a user used your product on that date or not. You can actually calculate all 4 of these numbers. So you can calculate signups, you can calculate daily active users, retention rate, DAU or MAU. All that can come from just this like 2-column table. If you want to be able to get some of these other numbers, you just need monthly customer revenue. So this is what I was mentioned earlier. It's important to keep track of how much each customer is paying you every month early. If you have this table, then you can actually calculate monthly revenue, kind of obviously. You can also calculate retention. You can also calculate this quick ratio, which is entirely determined by this. And to get these other three, you need that table plus one other one, which is how much you're spending every month on sales and marketing. So if you just keep track of what you spend on Facebook ads or Google ads, and then what your sales team or your marketing team is making, and have a table that keeps track of that, with that plus that monthly customer revenue, you can actually calculate all of these other things. So again, it seems kind of complicated, but not that bad. But there is another part of this that's complicated, which is, especially if you're like getting sort of later stage, or getting sort of the A and B round, which is how do you actually collect that data? Like those tables seem simple. They are simple if you're very small. They're not simple if you're a little bit bigger, because the data that comes from these comes from a bunch of different places. So if you think about like where you actually get this data, the user table comes from like production data or Google Analytics or whatever your application database is. Revenue can come from initially something like Stripe or Curly, but eventually you might have a sales team that's logging it in Salesforce, and then it's all manually entered, and that's a whole other story. And your marketing spend comes from all over the place. It comes from marketing tools like Marketo, but you're also probably spending ad dollars in tons of places. You're spending it in Facebook and Twitter and all these things, and it's very difficult to kind of aggregate all that together. The way that you can do this is like this. This is how we did it. This is an actual screenshot of what it used to look like for us. This is kind of hell. Every time you go out to raise money, you have to like someone spends a month to build these awful spreadsheets, and this takes forever, and it's a nightmare. There are better ways to do this. This is a place where some of like the data tools in the ecosystem do a really nice job. So there's a couple tools like Segment and Fivetran. There's a few others that fit into this bucket. There's a tool called Stitch Data. There's a couple other sort of ETL tools that will basically ingest all of that data into a centralized warehouse. You can use Redshift. There's also BigQuery or Snowflake or various other things. But basically can turn that kind of awful manual system into something like this that will automatically pull all of this data directly into a warehouse for you. So it centralizes it for you, removes this like awful spreadsheet hell, and can do this pretty quickly. We've actually, this is how we do things internally at Mode. Yes?
I noticed you guys raised a seed round, is that correct?
We've raised a seed or C?
No, a seed.
Yes, we did a while ago, yes.
Yeah. So it's how much, if you can talk about it, how much into your company was that seed round, and how palatable were these metrics when you raised it?
We raised the seed. We probably raised the seed without a product. I don't think we'd launched anything yet.
Okay.
There will be a slide that I think I show like our Crunchbase thing, and I'll look at the date and then I'll tell you. It would have been very early. So the seed round would have been either before the product or like we had just launched it and we had just signed a couple customers, or we had some customers that were like, this thing's great. We don't pay anything for it because we don't know how to collect money yet. But yeah, that would have been very early. The numbers would have been, like in some senses, very palatable. Like these numbers look great when you're really small because your things like LTV over CAC, you can kind of invent to be like it's 10,000 because people have paid us forever.
Those are projections as opposed to
Yeah, and everybody knows that's kind of fake. Like the thing really that you're raising that off of that early is you're raising it off of the story, the market, and early signs from customers. Like what are they saying about your product? If you don't have a product, it's very hard to like have any of this data obviously on it. And that is more true for B2B companies, because B2B companies, there is longer sort of timeline for that. B2C companies, people often want to see traction, or like they want to see a product out there and people using it before they invest in anything, because that's like it's so cheap to build apps now, basically. So to sort of wrap up this sort of data side, this is what Mode does. Mode also can help out with some of this. So Mode can sit on top of this actual database and build sort of live reports about this. So this is how we do our it's not so much fundraising as much at this point, but like all of our sort of core metrics are built on top of this system exactly like this. And I actually did this is a very simple thing to set up. I actually did like a demo presentation of this, that you can build this entire stack in like half an And then you can get all these metrics with like a button that runs in a few seconds. Like, what do you do now? How do you actually do this? Data is a really important part. If you're to the stage where you want to be able to start sharing this data, getting your data house in order is a huge part of this story. Also, to make this a little bit simpler, if folks are interested, we have put together some of these like templates for how to actually do this. So for all these numbers that I've talked about, there are templates in mode of assuming you have those 3 tables. How do you construct the various sort of graphs off of that? If you go here, you'll get a link to that, and there's a link at the end of this too, so you can take a picture, and then I'll show it later. So finally, with that, a few kind of closing tips about fundraising that isn't necessarily related to the data entirely, though it's all kind of related in some ways. So first is have a narrative. Second is you should have urgency, and the third is the market matters a ton. This actually gets to your question a little bit of, especially early, this market thing is really important. So is the narrative, to be honest. So the narrative bit. So data alone, even if you're later stage, unless you're like Series C and on, which again becomes a little bit more quantitatively sort of rigorous, data alone is not enough. You have to have like a compelling story about why it is that you should be the people to raise this money, why it is that you're the company that's going to be successful in this market. So there's this like first round review article that was really good on this, which is basically you have to be able to tell a story. Like storytelling matters. VCs will kind of present themselves as being quantitative and data-driven. They are people too. There are companies that can raise a ton of money off of really compelling stories that don't always have the great data to back it up. And so you can always make your pitch a lot better by having like a compelling narrative about how everything ties together. That's what connects these 3 things with this part. That's kind of how you tell the story around how your team is going to be the team that's the best for this market, why your vision fits this market, why your team is the one that came up with this vision and other teams can't. You need to be able to tie all this together in like a nice, clean way. So a few tips about this. One is when you're pitching, lead with your best story. Like open with the best thing you've got and frame the conversation around that. This was a mistake that we made, that we put together decks that sort of have this big build and they're going to like crescendo into this amazing reveal and it's going to tell this amazing story. And 2 slides in, you start getting hammered with questions and you never actually get there. And you show like a slide that's supposed to be a setup for this other slide, but it ends up being like this entry point to a bunch of questions that you never wanted to answer in the first place. And the whole thing gets derailed and it's really depressing. Lead with the best thing you've got. Like start with the slide that's the story that you want to tell, frame the conversation around that, and kind of own that conversation and make sure what you're talking about is that. If you've got this really great slide about like, look at our amazing retention, be like, people love our product. Here is this slide. Make that the core part of the story rather than trying to build to that and fitting that into some like big reveal. The second thing is understand who your customer is. That like different stories will resonate with different people. And VCs are people. They will have different stories about that they want to see. Some investors will be very compelled by some things. Some will be very compelled by others. Do a little bit of research, figure out what that might be. A lot of investors will tweet. They will have blog posts. They will do various things that you'll get a sense of like what it is that they find compelling. And so understand that, understand who you're talking to, and try to write a story that's crafted to fit those folks. And finally, get outside feedback. And so like, it's easy, especially when you're buried in this, to write a story that says, this really resonates with me. This is a great like pitch. We did this. And then we go out and like get feedback from folks and you're like, it doesn't make any sense. I don't understand this at all. Or like, this doesn't piece together right. Or I have all these questions from the very beginning as to why any of this matters. Get somebody who's never seen this before. VCs will look at this thing you'll get 15 minutes and that's it. They're not going to think about it that hard. Like those 15 minutes they're not going to be thinking that hard about it. They're not going to be in the weeds nearly as much as you are. And so get some sense of what it's like to get that pitch for the first time for 15 minutes from people, not just from people who've been thinking about this and kind of understand the nuance that you're trying to describe. Better data also leads to a better story. So one of the things that we did, like these are actually the 2 slides really that probably raised are like A and B rounds. So our A round, we had all the sort of main metrics, but we also wanted to try to tell the story about Mode being a product that like analysts really liked. And so we found this number of these blue bars are basically analysts, and they're using the product more and more every day. So this is like the average amount of time they spend in Mode. And this was really compelling because it fit to that story, and it was like this data-backed story that our A round investor was really excited about. Similarly, for the B round, we ended up trying. We're like this part of the story was it's something that's growing across a bunch of different verticals. It's not this like niche market where it's just data scientists and B2B SaaS companies are the only people who want to use this. We want to try to tell a story that, like, look, it's growing across a bunch of different verticals. And so we had this slide that, again, is it's data, but in reality, it's just a pitch that's trying to tell the story that we wanted to tell in a way that isn't us just putting up a bunch of bullets that seems like maybe refutable or maybe not. And we were able to do this because we had sort of the core pieces down. We had the core metrics that we knew people were going to be asking about. And we could spend some time trying to invest in figuring out, like, what is the data that actually shows the story we really want to tell. Second part of this is creating urgency. So this is a really important thing too, especially if you're like starting to raise money, but not really like, you're like, hey, we're thinking about going out and doing it, but we're not sure when. We're going to start talking to investors. There's like this process that you'll find yourselves in where it's like, I'm not sure how much we want to raise and all that. You want to create some urgency. Investors aren't going to invest if they don't think they have to. They invest because they don't want to miss out. Like, FOMO is a really strong thing for investors, and you have to create some sense that that might happen. Like, don't let them just wait it out and be like, I'll talk to you in a few months, and you'll come back in a few months, and then they'll see it again. I'll be like, show me a little bit more progress. Like, they will last longer than you will. I don't know the exact quote, but there's some quote of like you will be right. The market will be wrong faster than you will be right, or something like that. Like, if you have a sense of something that's right, you can't outlast the market. You can't outlast investors. They have money for longer than you will. You have to eventually create some sense of urgency. So a few ways to do that. Set a date. Like, if you're going out to raise money, say you want to raise it by a date. Like, you can just totally make this up. It can be artificial. That's fine. Just make sure they know you're not sort of floating around the valley trying to raise money whenever. Give them some reason why they need to have some compelling event to invest. A second part of this, and this is like a little bit more controversial, but don't take every meeting. Like, own the process some. That means if an investor says, hey, can we talk? Can we get coffee? Can we catch up? You want to keep investors warm, but every one of those meetings is an opportunity for them to reject you. It's an opportunity that's for them. That is not for you. You want to own that process more. You want to say, like, no, we're trying to close this round. Let's like have this conversation to figure out if we can get it done, and let's make that decision. You don't want to go, like, imagine if it's a job interview and you get called back 15 times. You don't want to do that. You want to say, hey, make your decision and move on. And if you put investors on the spot, like, you don't want to be like Mark Zuckerberg in the social network and like big league everybody by showing up in a bathrobe, but you have to have some ownership of the process. And again, they know they hold most of the cards. You have to kind of retain some of the ownership of that. There's another way actually that better data actually makes a really big difference here too, which is if you have better data, if your data is in a good spot and your pitch is in a good spot and it's tight, investors will know that other people could be ready to invest. That if your pitch isn't put together, if your pitch is still kind of loose, then investors know, well, nobody else is going to invest in this because this pitch isn't ready. If your pitch is tight and your data is tight, they will know that other people could be like, great, they could see this pitch and they could sign a check tomorrow. I know I need to have that same urgency. And so this is actually what we did. The way that we went out and raised from like our B round on was we basically knew the data people were going to ask for. We put it all together in like an Excel spreadsheet, and we emailed that out as our first touch point with investors and said, like, here is our data. Tell us if you want to continue. We are ready to raise this round. And so this was the email that we got back. This was like a pretty well-known VC that sent this to us. That basically was like, this is amazing. I want to keep copying this format. We'll get started and start digging in. And we were able to do that just because, like, this wasn't a, hey, here's a couple numbers. There's going to be a back and forth there. They're going to ask 50 questions about, can you show me this? Can you show me that? The more you can get out in front of that and just say, here are the numbers. You have what you need. Make a decision. The faster you can move this process along. Finally, markets matter. So in all of this, this was another sort of mistake that we made, was thinking, hey, we can pitch a great product, we can pitch a great team, or what we think is a great product and great team. That's enough. It's not. Investors want to know that there's a really strong market out there. You need to show that there's actually a way for you to turn this product into something big. So what that means, there's a couple things that really means is, one, understand who your customer is. And so that means not just like I am selling to business users. I am selling to, if I am DoorDash, I am selling to people who buy food. It's like specifically, who are you selling to? Are you selling to a very specific type of people? Are you selling to distressed parents that are trying to order food when they just had a newborn baby? How big is that market? Like, think really critically about who you actually can sell to. The tighter that story is, the fewer questions you'll get about Similarly, especially if you're raising like institutional capital from Silicon Valley VCs, you want to show a clear path to $100 million. This is like the benchmark for what people want to see.
This is sales?
Yeah. It's just like the reason for it. It's a nice round number. The multiples that software companies typically get is like 10 to 1 on revenue and valuation. That means the company is worth $1 billion, which is an even nicer round number. Like they want to invest in billion-dollar companies. Therefore, show us how you get to $100 million in revenue, and then we'll feel comfortable about investing in it. This is all kind of made up. Like the important part of this is not how precisely do you get there. It's have you really thought about this? Have you really thought about, okay, great, we have an app that will help us like order food online. Have you actually thought about how you really turn that into a big business? It's easy again to say, yeah, everybody will want to use it and everybody will order food, but what does a world look like when you actually make that big? And the more you can define that for folks, the fewer questions they'll have about it. So like the better data you have on that market, the better data you have on your path to get there, you won't have to answer as many questions. And you'll get questions about this. These, I think, more than anything, are the kinds of questions that derail pitches because they're often places where you don't have an answer ready. Like it's easy for you to answer, but talk about your team, why it's great, about your technology, about your product. If someone's like, well, how big is the market for this thing? And you don't have an answer, it just becomes this sort of, it's easy to derail the conversation on this part. So just have some answers for this, understand what your market looks like. It's something that people care a ton about. So finally, if you want more of this, I am by no means the expert in all of this. Here's a few good resources. So one, there's an investor at Redpoint called Tom Tungas. He started a blog a while back that's primarily about SaaS businesses. He was like an investor in a bunch of SaaS companies. Primarily about how he thinks about the metrics around public SaaS companies. And obviously public company metrics aren't the same as a seed round company metrics, but they give you an interesting insight into how investors think about this. And a lot of the work he tries to do is talk about here's how public company metrics stack up, and here's how we can translate that into startups. And so it's really useful to kind of understand the connotations of the way investors think. And so he's a good resource for that. Another person that folks probably heard of is Jason Lemkin. Jason Lemkin started SaaStr. He kind of became prominent by writing answers to a bunch of questions on Quora. He's much more like early stage startup focused than Tom Tungas is, also more SaaS focused. But another place that's a really good sort of perspective into the mind of an investor, how they think about, in his case, not just sort of the metrics around the business, but like how they think about leadership teams, how they think about hiring, how they think about different stages of a company and how to interpret those. Finally, there's the Social Capital, which is a now, I guess, defunct VC that was started by Chamath, the Facebook growth guy. Put together this thing they call the Magic 8 Ball. Basically what it is it's this thing you can plug your data into and it will spit out a bunch of metrics of how they would look at them. It was kind of their like calculator for whether or not they should invest in a company or not. The specifics of this thing aren't quite as interesting as there's this whole blog series around it by a VC named Jonathan Shu. He wrote basically how they look at these metrics and how they look at like growth metrics for companies, how they look at like revenue metrics. A lot of the DAU or MAU numbers are things they talk about. The quick ratio is something their big focus is on. And so this is a good resource for understanding like some of the more quantitative sides of how VCs think about that. So finally, the like last point on this is you will get rejected a lot. So in the course of all of this, here's this slide with when did we raise this seed round? 2014. We had launched a product 2 months before that. So we had like some customers who said they like it, but that was it. So in the course of all of this, like I don't know how many emails we sent to investors, hundreds probably. We probably have pitched 100, I don't know, a lot. Like we've been in sort of the final stage pitches with 40 total. Like it's like a job interview. You're gonna have a bunch of things that aren't yeses. It's discouraging. It sucks. It feels like it's never gonna work. But it's like a job interview. Eventually you get one, and all it takes is one. And so like it will be frustrating. There are lots of people who will say no. That's okay. That's part of the process. You will learn from it. You will learn from the things that they say. I think the most critical thing about the people who do say no is take it seriously, but not too seriously. Like everybody will have a reason. You want to listen to those reasons. You want to understand what it is that isn't resonating, but don't take that as like that means your company won't work. It means your idea won't fail. Again, it's like a job interview. When you get rejected from a job interview, you have to take the feedback, but know that that doesn't mean there's a job out there for you. There are lots of investors in Silicon Valley. There are lots of people who want to put money into great companies. If you're able to put together a great narrative, you will find somebody to invest in it. But you have to kind of work through those no's, understand them, and evolve your pitch, and let it evolve to fit the stories that you're hearing from companies, but kind of stay true to what it is that you want to do.
The debt financing mode that you got there, did
Yes.
you do that on purpose, or the company was kind of
No,
launching at that
I mean,
point, or
well,
why would you have done the debt?
no, I mean that was like 4 months after this, and we were 3 people at this point. This is a little bit of an artifact of Crunchbase, to be honest. So the way that this worked was we raised this seed round, we like announced it, and then you basically leave the round open. So we essentially were like, great, we got some money, we want to like go recruit a few people, let's announce this as soon as we can, but we left the round open, meaning that more people can add on to it. It was really an extension of this. And so I think we just like, yep, let's continue to raise more money at the same valuation because we can, because we have some interest. This was not like a debt financing, and it's debt financing, I think, because it's a convertible note, which is a slightly different thing, and like there's some like financial gymnastics. But
you weren't going to the usual suspects like the banks or
no, and certainly not at that stage. Like if you see a debt financing round here, that's typically like, okay, well you've raised some money and now like you're trying to find capital anywhere. If you see it here, like again, this is 4 months after having raised this money for 3 people, we weren't paying ourselves that much. So yeah, with that, questions, rather than leaving that up, here are the links to stuff. Happy to answer your questions, and yeah. Yes.
Can you talk a bit about who you go to? What I mean is there's options like using the online tools like Crunchbase. There's warm contact. You know someone that knows someone that can introduce you.
Mm-hmm.
There's cold pitching to angels.
Mm-hmm.
And you know, I've raised a bunch of money through warm pitching.
Mm-hmm.
Cold pitching seems to go nowhere,
Mm-hmm.
but there's more opportunities for it. I haven't spent much time on the Crunchbase type online tools. Can you speak to those a bit?
We have not done anything through like the angel lists and the sort of crowdfunding platforms. I would say go to warm people. Like go to warm people and try to turn those into more warm people. Cold pitching is impossible. Like cold pitching only works if you don't need it, really. Like if you're prominent somehow, you can just email somebody and probably get a meeting. But in that case, you probably know everybody anyway. Like those are the only people I know who have cold pitched successfully. Is they started some other company and they just like emailed somebody at Excel and they're like, hey, I'm the founder of this thing. And they're like, oh, I'll take that meeting. But like they could have gotten an intro anyway. The way that I would recommend most folks do it is try to meet people, try to get more meetings. The people you can often go in through are associates. So associates at VCs, that's their job. They're basically like sourcers. It's like if you want a job at a tech company, just email a bunch of recruiters because their job is literally to take that inbound and turn it into something. Similarly, that's what associates do at a lot of VCs. Is their job is to take 100 meetings with companies. You don't want to take a bunch of those meetings because those people don't actually have the ability to write any sort of check. But they're a good way to kind of get a foot in the door, and often they'll invite you to some sort of thing or what. Like you can start to build a network through that. But yeah, cold pitches are like finding an email and just sending somebody a thing and like, hey, here's my deck.
No, I mean
that's
showing up to a list of angels that you don't know and giving a pitch to them. I call it a cold pitch.
So yeah, I don't have an answer to that. I don't actually know what if you go to the sort of like a Silicon Valley Shark Tank type of thing.
Yeah.
I would imagine that's tough, but I don't know. That's not something we've done. I try to get intros is generally the way that I would recommend it. Yeah.
A bit of a tactical question here around service providers like lawyers and such
Mm-hmm.
in the process of fundraising.
Yeah.
To speak to how did you think how long prior to closing the round you had a lawyer ready?
So I mean we had a lawyer from day one, and that we had to incorporate the company somewhere, and you need a lawyer to do that.
You can use Clerky.
Yeah, well, I don't know if that was around at the time, but the way a lot of lawyers will work is they will basically they won't charge you until you raise the money, and then they'll charge you out the ass. But like a lot of the lawyers they'll basically like charge you not a percentage of what you raise, but essentially like there's not a world where you typically stuck with a huge legal bill and not having raised money. Generally, our approach to this was that like the money is worth it to get that done right. One of the places, this also depends on who you raise from. One of the things you want to avoid is getting like bad terms. Like if you get, and there's bad terms of like somebody bought 50% of your company for $10,000 and like that's a bad deal. There's also a bunch of stuff that can go into term sheets that are like liquidation preferences and people getting ability to veto other rounds and all this stuff. And you want like a standard version of that. I think Stripe actually put out something of like saying, hey, here's a term. Somebody put out some stuff that was like, these are the term sheets everybody should use. Don't change it. You want to make that happen. Like the main reason is, part of the reason is because like bad terms are bad terms, but also every subsequent round will layer on worse stuff. And if you start with like a bad foundation, the next VCs that invest will be like, oh, well, we have to sort of supersede these bad terms these other VCs put in place because they got some sort of like veto right, and we need to make sure we have some veto right that like vetoes that veto right, and you end up with this sort of awful like house of cards of bad terms that all of it is bad for the founders or the entire company really. So generally, our approach was, yeah, we can engage lawyers if we raise the money. I don't know how much of the original $500K they took, like not a huge amount at that stage, but it's worth it to like make sure again you're on kind of a solid initial foundation from a legal perspective. Yes.
When you talk about setting a date when you're raising capital, like what's okay date? 2 weeks, a month, 3 months?
It depends on where you are. So like if our approach was typically when we first engaged people in the sort of middle like A-B rounds, probably like the B round, we basically said we're engaging people. We want to have it done in like 6 weeks. That's a pretty aggressive timeline. Like closing like an A or B round in under 2 or 3 months is pretty quick. I don't actually know if we got it done in 6 weeks, but we at least got to. What it let it at least do is get past the sort of like awkward beginning dance stage where it's like, let's meet, let's have coffee, let's talk about it, let's tell us your vision, tell us why you're a good VC. Like got to the point of like, we are pitching you, you are making a decision. They probably did some diligence afterwards to sort of like, are we committed to it and stuff like that. But it made the process real. And that was, I think, the important thing is we didn't just like sort of churn our way through this kind of like, are we friends, are we not, I don't know. If the other way you can do it is if you actually are further down and you're getting kind of sick of like that dance. There were a couple of places where we're like, we want to have this done in 2 weeks. Like we want a decision in 2 weeks. That's what we're telling everybody. All of the people we're talking to and sort of this sort of batch of people we're pitching. We're trying to like the way investing works is there's an initial pitch, a partner will get behind it, and then you have a pitch to the full partnership. And we're basically, and those pitches always happen on Monday. It's just the way the industry works. We're basically saying we want to have those partner pitches on this date in like 2 weeks. That's when we're trying to line them all up. Like if you're in, that's the day to be in. And again, it forces a decision. And in a lot of cases that doesn't work. Like a lot of cases, like all right, well we're out. And you're like, well, have enough people lined up that you can kind of get away with that. And you have to feel that relationship. Like if you feel like everybody's going to be a no, you can't really play that card. But you want to be able to have like a little bit of leverage in this, and for the most part you don't, and so you have to force it some. Yeah.
Were the lawyers helpful in getting you investor intros?
No.
They all claim that.
No. No, they were not. One thing that's a little bit of a caveat for that for us is we had the fortune of me and the two folks that I started Mode with all came from a company that had been acquired recently, and so there's a little bit of a halo effect that you get out of that, and so we knew some people around the valley because of it, so we were able to get some introductions, so we didn't have to go that route. But I can't imagine that lawyers would be super useful. Like I can't imagine I can imagine lawyers being useful for seed rounds, or I mean for angel rounds, because we actually have had a couple lawyers invest, and I can imagine that like they know networks of just basically well-off people in Silicon Valley that are like looking for deals and sort of their hobby to put 50 grand into companies because they have enough money to not know what to do with it. I don't think they're good for institutional investors because I can't imagine like Sequoia is like, oh, we got a call from this law firm. They have a hot lead. Like, that's not how Sequoia works. Yeah.
For a seed round, when do you recommend to do with Asian investor or VCs?
With what kind of VCs?
When do you recommend to do or angel investors or VCs?
Oh, angels or VCs. It depends on how much you want to raise. I would, from our experience, I would say if you're like trying to raise more than like $1 million, going some institutional route is often better. The main reason for that is you don't want this to take too much. Like, this isn't making progress. The frustrating part of this is you're not like getting anywhere and building your business and doing this. Like, you are kind of, like, it's necessary, but like it doesn't really feel like progress. And if you're trying to raise a bunch of money from angels, unless they're angels that can put in a lot, like there are some angels that will put in a couple $1 million, unless they're angels that can put in a lot, you end up spending a lot of time like wrangling cats to do it. You don't want to be constantly fundraising. Like, it takes up a lot of time. It takes up a lot of mental headspace. If you're every week having to go out and try to find a 50K check, you can't focus on the thing that really matters. And so that was kind of our goal, was if we're raising it from angels, we need it early. Let's get it done. Let's like, that is the thing we're doing, and let's close the round. With the exception of that, like again, we got the sort of the add-on that was from like just a couple of people. Let's get it done, and let's not like spend a bunch of time sort of passively fundraising for 9 months. So it was more of like, how big of a check can you write? Like, we didn't want to be collecting checks from 30 people. It was like, we wanted every round to be, this is 5 people, that's it. Like, we don't want to go beyond collecting checks from some number like that. And you'll often get like little add-ons, like the lead angel will invest and they'll have like, their lawyer will come in and be like, oh yeah, this person wants to put in 20K. And like, do you want to take it? Maybe, I don't know. Like, that's up to you. But our goal was, yeah, not to having to do this like kind of constant fundraising process. Yeah.
I have also a question around the seeding fund. So how do you determine how much your money you want to raise during the seeding fund, and how much stocks? I mean, do you really need the money to build your first product? No, or it's no, maybe not a portion of that. You plan to raise another round of funding for that first product. Another question that, how much share you normally trade for those funds? Is there a rule like 20% of your share?
So how much do you raise depends on what you're building. And also how much do you want to, like what kind of business do you want to build? So if you are building a SpaceX, you got to raise a lot. Like, raising $2 million to build a rocket's not going to help. You're not going to get anywhere. If you're building like a mobile app that you can build with 2 people in 6 months, don't raise that much. At that point, it becomes more of a decision of like, what kind of a business do you want to build? Do you want to build a business that's like you're trying to dump a bunch of money into it and you're committing to making it big? Or do you want to kind of like try to find some traction and then see if it works and then grow it more, so like less aggressively? Like, one of the things that will happen is as soon as you raise an institutional round, you are committed to a certain path. Like, institutional investors have expectations of like that T2, D3 thing. They have expectations of growth rates like that. They have expectations of how do you get to $100 million in revenue. If you're going out and raising money from a big institutional VC, that is the direction they want your company to go. And to them, they would rather you attempt to do that and then the whole thing blow up than you attempt to turn it into a business that becomes profitable at $4 million and grows to $6 million in 10 years. And you may be happy, but like, that's a write-off to them. That's the same as the investment going nowhere. And so that's the decision around like taking institutional money, is really like, what path do you want to be committed to? And so how much you raise, again, depends on like if you were trying to raise $5 million, but you don't want to go down that path, that's going to be hard because there aren't going to be many people who want to go down the like, grow a small business and let it become profitable with giving away that kind of money. But if you're trying to raise a seed round, you can find people who might be interested in just like, I want something that's maybe a little bit more of a sustainable investment. In terms of how much do you sell? So the rule of thumb on like A and B rounds is they are typically 20 to 30%. 30 a little bit on the high side, 20 a little bit on the low side, like 25% is pretty much normal. Once you get later, especially if like you get very, very big, obviously like the Uber's not selling 25% every time they raise money. The seed rounds can be a little bit more variable, and that depends a little bit on like your position. If you're someone who like, hey, I have like nothing and I want to go try to sell this company from the beginning and there's no traction or anything, people may invest in like the idea, but in that case, you're gonna have to sell a little bit more. I think that if you have a product and idea and like you're already sort of starting to build it, seed rounds typically are smaller than the 25 to 30%. I think most seed rounds are probably in the like 10 to 15, in part because it's like here is sort of starter funds to pay you and a couple founders to be able to work on this idea for a year. And a lot of those people are just investing in tons and tons of stuff and expect most of them to not go anywhere. They're like looking for the one big hit.
So do you find there's a threshold or tipping point in terms of the funds raised that helps you get more funds? And then also, you haven't talked about IP. How does IP versus first market fare in all that?
So a tipping point for raising more money, not really. Like I would say the thing the bigger play there is basically, should I take you seriously? I think that if you want to go raise from like the top tier folks, if you want to raise from Sequoias and Andreessens and those sorts of folks, a part of that is like, should I take it seriously? And I think the amount of money that you raise is a little bit less than that. Rather, it's like, this is where like the network matters. We're like, do you have cachet? Have you worked at a place that I have heard of? Do you know people that I know? I don't think it matters. Like, I need to raise $5 million, otherwise these other people won't care about me. That is true in the later stages. If you're trying to eventually go raise $100 million from some like PE firm, they're typically not the first money in. But yeah, I don't think there's like a number you need to try to hit of like, hey, we're not going to raise money after that. The other side of that though is, and this matters particularly like the A and B stages, you can raise too much. This was like a HBO Silicon Valley joke that was actually very real. Like you can raise at too big of a valuation. There is danger of going out and raising like at the top of the market that you can raise on if you don't think you can hit that, because now your expectations are to hit that. And that means, say you don't hit it, the next time you go out and raise money, it's like, great, we've raised money on a $100 million valuation on $1 million in revenue, and we ended up 5xing it to $5 million, but like it took longer than we expected, and it wasn't as, like unit economics weren't as good, and now it's like really hard to hit that goal we were supposed to hit, 10 million, and like, what do we do? And we 5x'd, we should be in great shape. But the expectation was something much higher, and so like the market kind of shift on that. So there is like a raise reasonably, but I don't think there's like a tipping point of how much you actually raise.
What is typical revenue at Series A?
What is what?
What is the revenue at Series A?
Oh, how much? Yeah. So that's a little tough because like B2C companies, there is a good, I want to say the number is probably like 1 to 2 million, maybe less, maybe like half to 1.5. There's a
Annual, you mean?
yeah. And that's for B2B. B2Cs, again, we don't run a B2C company. I don't know. They never make money. I don't know. That's the point. They're pre-revenue. There is what's the guy's name? Christopher Jans, I think. There's a VC that's like based in Europe. I think if you just search like VC JANZ, there's a guy who has this sort of like back of the envelope calculations for, I think he actually did some surveys. It wasn't back of the envelope calculation, that was something else. He did some surveys where it was like basically what are the revenue numbers for like seed A, B, C companies, and it was like 25th percentile, median, 75th percentile. That I think gives some decent sense of those. It's the revenue numbers and the growth numbers of like, an A round was at $800,000. The 25th percentile was $800,000 growing at 2.5x. The 95th percentile was $4 million growing at 10x. I don't know, but something like that. But yeah, that's a decent. But it's in the low single digits of millions, I would guess.
You can work that backwards from your 3x, 3x, 2x. So like, let's say that you're trying to get to 100 million.
Mm-hmm.
So if you multiply all those together, that's 72. So it'd be like 1.5 million or something.
Well, but those don't necessarily correspond to the rounds. That's like the years, not the rounds.
Right. So that, I guess that's like after a year you want to be at 1.5 million.
Well, so the way kind of people think about that is that like clock doesn't start until you hit 1 million, basically. It's like, or roughly, like it's all kind of ballpark. But like, yeah, if you hit 1 million, it's like the next year you want to get to 3. And once you hit 3, the next year you want to get 9. And the next year you want 18. And like, that's once you're in that time, that like sort of number. If you're in the...
So how often are you raising a round? Is it like once a year,
No, so people, the rule of thumb on that is you typically want your round to last 18 to 24 months. And actually, I think that's pretty like this was like I guess from here to here was a year and change. From here to here was a year and 9 months. From here to here is a year and 9 months or so. So yeah, that's like basically where we've been. But that's like, you want to raise on roughly that cadence. You typically want to be able to like say the money will last you 2 years. You probably want to raise a round once every 18 months. Like raise the round not on the sort of fumes of your previous one. But yeah, that's kind of ballpark. Yep.
So based on your experience, how much can affect the first investor that you have later on?
How much? It depends on who it is. So like angel investors can be useful for introductions. They can also be useful for like validation. It's like how seriously do people take it? If you raise from a good angel, that can help with introductions to other people. That once you get past like an A stage, you can get introductions anywhere. Like it's once you're sort of in the ecosystem, it is very easy to find somebody who knows somebody who knows somebody to get an introduction to places. And so I think like the network of the seed investor, angel investors, there is value in sort of getting you past the seed round to like an A stage. Once you get in that world, like it's a small enough world that everybody's 2 degrees separated from everybody, and you can meet people pretty easily that way.
So in your fundraising curve, where did all that money go? How much of that went to people? How much of it went to?
It all goes to people.
I mean,
like
was that? How much of that was marketing people, sales people? How much of that was technical people?
So it overwhelmingly goes to people, and to like, if it's not, that will raise red flags. Like, company investors will be, and the people running businesses should be concerned if you're spending half your money on marketing, unless you're FanDuel or whatever, and that's your business model is to spend a ton of money on Super Bowl ads and eventually realize your business model is illegal. In terms of the split of the types of people, I don't know if it changes as companies mature. I would say early stage, it's overwhelmingly technical. That of our first 15 hires, 2 were non-technical or non-product. So design, product engineering. We had a salesperson and a marketer, and that was it. Later stage, that starts to balance out. I would guess for a B or C round company, the head count is like half and half, technical, non-technical. And eventually, if you're like Salesforce, it's overwhelmingly non-technical.
What's your head count now?
Moti's about 90. And I would say that is 50 to 60 in the product organization. Again, PMs, design, engineers. Then there's sales, marketing, support and operations, stuff like that.
When's your next funding round?
18 to 24 months after the previous one.
I have another unrelated question. Well, it's sort of related. What about a company where the product is going to take 3 years?
So that's how there are B2B companies that are that.
What about B2C? I'm talking
if you're a B2C company where it takes 3 years for you to build a product, you got
It's a
some
device.
you got some selling to do.
Medical device.
That's I don't know anything about that. It's blood samples, huh?
It's sterile done properly.
Yeah.
That's what I'm selling.
That's an uphill battle. But for B2B companies, there are B2B companies where it's like this is a harder tech to build. That often means the first 3 things in that pitch have to be really strong. And what that really means is like, why are you the person to do it? And in some ways, there is a battle that you cannot win there if you are not that person. Like, you have to be able to sell that. If you're going out to say, hey, I want to raise $50 million to build, if I wanted to raise a machine to like make IKEA furniture for people, I have to have a reason why people would believe that I can do that. Maybe I've already built a prototype that works amazingly well. Maybe I was the original designer of IKEA furniture and I have some special insight. Maybe like I have a team that can do it, but there has to be just because I have the idea, that's not good enough. And for that kind of, you can raise on an app idea to raise 500K. You cannot raise $50 million on like, I have this amazing idea, but somebody who had that idea could just find a better team to do it. Like, there has to be a reason why you are the right person to do that. And that's then it's like a sell.
Yeah.
Cool. Yeah.
How often are you asked about exit strategy and how do you handle
From
it?
investors?
Yes.
When you're raising money, not a lot. The answer to that is we want to get to $100 million in revenue. Like, the answer is not we have an exit strategy. Do not say we're trying to sell this.
Right.
Like,
They don't want to hear that.
no, they are there to make a big business. They're there to make a bunch of money. They are not there to have you acqui-hired by Dropbox when you're 6 people. And even if you're like, we want to have an exit strategy of being bought as a $1 billion company, you don't get bought as a $1 billion company by trying to be sold as a $1 billion company. You get bought as a $1 billion company by trying to build a company that's going to be sustainable, and somebody says, hey, you've built a sustainable company that I want to buy for $1 billion. So the answer to any exit strategy question is like, we're not thinking about that. We're thinking about how do we make a bunch of money and build a really successful business. Cool.
Thank you, everyone. That's it. I will send the slides. Yeah.
I can do that.
So we'll do that. I'll email it to everyone. Our next talk is going to be next month. It's going to be about sales, and I will email you about it.